Okay. Hi, everybody. This is Giovanni, and this is episode number 17 of a Physics of Bitcoin. I am here with my co-host Stephen Perrenot, and like always, we say a little bit about the show. The show is about uh, talking about a, a little bit more detail topics related to Bitcoin from a mathematical and physical point of view, because both of us have PhDs in physics. We have experience in applying physics in many different fields, and we think that Bitcoin can be studied scientifically in this way using tools from physics, analytical tools. So it's a different show from what maybe you can find in other YouTube channels, and I think it's a valuable approach in understanding Bitcoin. Every week we cover different topics, and Stephen, you can add or subtract what just said, and maybe you can show the agenda for today also.
Yeah, okay, that's great. Let me share my slides.
Okay, let me.
Okay, how's that?
They look nice. Like
Okay,
always.
good. It's April 9th. This is our 17th Physics of Bitcoin show. And I thought that this week, since we've all been waiting for more liquidity in the markets, while we have the tariff turmoil going on as well, we're also waiting for larger input of liquidity. So I thought I would cover that topic, liquidity and bubbles. So here's the agenda. First, I'm going to present, and I think we've shown this before, what Michael Howell of Cross Border Capital had found. He's got his own proprietary liquidity index, and he found that Bitcoin adheres to a steep power law. I've done my own study in the past week. I don't have access to his series, so I used a different series. This is the OECD M3 money supply. It's the aggregate money supply for the 38 nations that are the developed countries that belong to the OECD. And that's actually available on the Federal Reserve website, FRED. What I found is, and I'm going to show you, is that high liquidity growth kicks off bubbles. And that statement is a little bit careful. I'm not saying that it is responsible for everything that happens in the bubble, but it appears to kick off bubbles. And the other thing we can do, and Michael Howell also did with his study, is we can do Granger causality studies. And the idea is that liquidity is a driver and it leads other assets. It's known that it affects the stock market. And I did a liquidity study in the past week for gold, just to show you how this works. And then, of course, I did it for Bitcoin as well. And there's some interesting results that I'm going to present. So that's the core of what we're going to go through today. And at the end, in previous shows, I've shown that the power in the main bubbles drops is the inverse of time. And I tried to build an analog with gravity waves and water, and I'll present that. It's not that great a fit, but just to get the idea behind physics modeling, I'll present that. And then I'll show how the bubble power fits to the market cap. And surprise, surprise, it's another power law. Okay, so let's dive in. So this first is the work from Michael Howell of Cross Border Capital. And what he's got is a log-log graph. And on the y-axis, he's got Bitcoin price. And on the x-axis, he's got his proprietary GLI, which is the Global Liquidity Index. And when it says log scale, this is natural logarithm. He used natural logarithm. It doesn't matter for the slope. So both of those axes are natural logarithm. And what he found is the dotted line or dash line, I guess it's a dash line that goes through the, the orange data points is a best fit. That's a power law because it's a straight line on a log-log plot. And so he found a power law index of 9.72. He also got a very good R squared of 0.9. So he's got Bitcoin price growing as the 9.7th power of his liquidity index, very close to the 10th power. Now, his price range spanned from when Bitcoin was $200, up through the recent $100,000 zone. There's also a statement at the bottom that he said he found that global liquidity is strongly Granger causal statistically, and the impact on Bitcoin is positive with a lead time of something like 12 weeks. And you'll see this a lot, on X, people talking about this lead time, and different people say 11 weeks, 13 weeks. It's in that neighborhood, typically, is what you'll see. Okay, now this is the series that I constructed. Again, it's 38 countries. It's the developed countries, so China and India are not in this index. I will also say that this is money supply. This is the broadest money supply measure. Howell's index also looks at the details in the banking system. So it's a more complete index than this one, but this one works extremely well. It provides a very good fit. So what we have on the y-axis is the log 10 of the index. What I downloaded from Fred is actually the growth rate year over year, and that's the red dash line, and that is shown on the scale on the right-hand side of the chart. I reconstructed an index normalized to 100 at the Genesis Bitcoin block, or really January 1st, 2009. And so you can see that follows a pretty steady kind of progression. It's more or less exponential because you have log on the y-axis, you have linear time on the x-axis in calendar years, and then you see the big bump, which was the injection of a huge amount of liquidity to deal with the COVID crisis and the aftermath of supply chains and all of that. You also see, in the growth over the growth, which is percentage, you see that that's a huge bump, right? Going between 15 and 20% at the peak. So that was really abnormal. But you can identify 3 or 4 peaks in growth, and we'll see that those correlate with the Bitcoin bubbles, and they lead around a year. We'll see the details. So first, there was one before the Genesis where it was over 10%. And on the left-hand side, we're just seeing the decline in the red dash line as it drops below 10%. And, the bubble came in 2011, and that was the sort of first bubble that was out of cycle. Then the next bump up is January 2012, and the peak growth rate for OECD M3 money supply was 8.7%. And that preceded the 2013 bubble. Then at the end of 2016, there's another one, and I've drawn a 7% line. So, all of these broke through the 7% level. That one hit 7.2%, and that was, a predecessor to the big 2017 bubble. And then for the last bubble, we have, this very large run up post-COVID. It hit almost 20%, 19.7% at the peak. And the peak was February of 2021. And as we know, the bubble peaks it's actually a double bubble occurred in that same year. Okay. The next slide is my regression, log plot. So the blue dots are all of our data, which is a scatter plot for, log 10 of Bitcoin price against log 10 of this M3 index. Now you can see that we span a broader range for price. We go from -1 in the log to 5, so that's 6 orders of magnitude. So that's about 3 orders of magnitude greater than what Michael Howell's study covered. And yet we still find a power law, and in fact, the slope is steeper. The best fit slope, this is an ordinary least squares regression in the log space, is 11.5, and the uncertainty is about 0.36 for that. And the R squared is quite good, it's 0.86. So even though we've got a lot more data, or at least longer span, we're still seeing nearly as high in R squared. Okay, so let's look at the relationship between high liquidity growth prior to bubble start. So the large chart in the middle has all 6 bubbles that I've previously identified by taking out a power law. In that case, it was a quantile regression median, and using the size of the residuals in log 10 terms to identify bubbles, and that bubble level is at 0.6 in a quantile regression. And there were 6 identified, of which 3 were the largest. So if you've been in the previous shows, you've seen this chart presented. The 3 largest are the well-known ones in 2013, 2017, 2021. And I've got their duration in the column after the start column, and they typically last, longer than a year, approaching a year and a half, exceeding in some cases, in one particular case especially. I've got the weeks to peak tabulated, and then I've got the average power, which is important. And we see the average power has come down over time. And then I show the age at peak in years. And then this is important for this study is, did the liquidity growth exceed 7%? And if so, how many months? And what we see that only happened in 3 cases out of the 6. 2 of these bubbles are quite small. The 2011 one was fairly substantial. But it was just our big kind of regular 4-year space bubbles that had liquidity growth greater than ever exceeding 7%. And it lasted for at least 4 months and then up to 8 months. So in the little chart that's up above, you see just those 3 summarized. And I show the peak date for the M3 liquidity, the peak of its growth, and then the bubble start, and then the delay in months. So what we see is that the delay times were respectively 14, 8, and 10 months. So about a year. The average delay was 11 months between when the OECD M3 liquidity index hit its peak and when the bubble started. And the start, again, is in those upper 40% of the residuals. Okay, now I've done Granger causality studies for both gold and Bitcoin. This one is for gold. Now, our driver here, the liquidity, grows roughly as an exponential, something like 7% compound annual growth rate. And gold also rises exponential. So individually, they're not power laws. In the upper inset, in the upper right corner, I've done a log-log regression, and we find that indeed there's a power law between those 2, even though individually they're not following power laws. So that's kind of interesting. Basically, gold is rising as the square root of the growth in M3. The R squared is not as good. There's a lot of scatter in this. It's 0.48, but there's clearly a pretty good relationship just looking at the graph. Now the causality is shown in the large chart, and there are 4 different cases. The base M3 index versus gold price, the M3 index versus log gold price, the growth, which is the year-over-year change in M3, and how much, leading gold, and then the M3 growth leading log gold. And the number of lags is just months. So we're looking at lags between 1 and 12 months on the x-axis. And what's plotted on the y-axis is what the Granger test gives you, which is a p-value. And the way this works is, in order to demonstrate Granger causality, you need a low p-value. In fact, you want it to be less than 0.05. So that's the dashed line at the bottom of the plot. So what we find is that the green line drops below that, and the red line drops below that. The red line gets very close to 0. The green line gets down to around 0.02 something. So it's, half of the 0.05 requirement, and the red line gets down to around 0.01. The red one is the Granger causality between the M3 index and the straight gold price. And we can see the minimum is reached around 6 months delay, but also around 10 or 11 months. So in general, since 10 and 11 are both low, you would say that's probably the more likely lag here for Granger causality from the M3 index to gold. The green line is M3 growth to gold, and that's interesting. Growth has a quicker effect because the growth is changing more rapidly than the long-term trend, right? You're seeing bumps in the M3 growth. So it seems to lag by about 4 months, or, the M3 leads by about 4 months. Gold lags by about 4 months in this.
And for growth, you're calculating just the derivative.
The growth is actually the actual data download, and it's the year-over-year percentage change in M3.
Oh, yeah. Okay.
And then I reconstructed an actual M3 index based on the growth rates.
I see.
Okay. Okay. How about for Bitcoin? Now, for this one, we know that Bitcoin is a different kind of asset than gold. It grows as a power law relative to gold, relative to fiat. And we're interested in how it behaves in the bubble zone and how it behaves in the core zone. And then we have this transition zone. So in this upper plot, we have the change in liquidity, which is year over year, and the Bitcoin log 10 residuals. That's after I subtract the power law. What are the residuals in relative terms, log 10 terms? And you can do it in percentage terms. It's not going to look qualitatively very different. But that's what I chose here. The blue line is the core zone. You see that it does not meet the Granger requirement, which is the red dashed line at the bottom. The green line is the bubble zone. It's the worst of all, actually. There's not Granger causality between M3, in this case, changes in M3, and this, the size of the residuals and when they occur. We only see nearly Granger causality for the transition zone, and it occurs at 6 months. So I'm saying we missed it by that much because the desired level is 0.05 and what we got was 0.065. And the lag is, 5 or 6 months. That the 8-month comes down low as well. So for the sake of argument, we'll say it's a 6-month lag, but it only applies to the transition zone. Does not apply at all in the bubble zone and is not there in the core zone. There's a little hint that it's dropping down around 8 months, but it just doesn't get close. The smaller chart below is similar. One of these is actually absolute change in the M3 liquidity, and the other is year-over-year percentage change. But they both look more or less the same. So the interpretation of this is that liquidity looks like a trigger with a half-year lead, but it does not appear to be a continual driver of the bubble behavior. It triggers the start. It triggers, being in the transition zone and getting up to start into the
Yeah, and this is
into the bubble zone.
This is what I noticed too, because I noticed indirectly that there is always an excess of liquidity just before a bubble, and then the bubble does its own thing because I think it's driven mostly by FOMO.
Right.
I mean, liquidity does its own thing. They became decoupled, but they start together. So that is the
Right.
transition. So
this is precisely what this is showing. So this is confirming your postulate or thesis there. This one is just the straight liquidity index and the residuals. And, we see it, but not as well. But now it's in the core zone. It's not in the transition zone. Now, this makes sense if you step back and think about it. This is the liquidity index. So this is the long-term thing. So it's helping, actually, growth of long-term liquidity is helping to drive the core power law behavior.
a very loose way, right? It's not a strong driver. It's
But
just
it's
like,
not, it's not strictly Granger causal, but it's
right.
closer. So liquidity is perhaps driving some of the longer term core power law growth, which would not be surprising, but it's not triggering the bubbles. It's the delta, the changes that are triggering the transition zone, and they're not sustaining the bubbles. You need the momentum and the FOMO, and the hedge funds coming in, playing the game to keep the bubbles going. Now, this is a switch to something different. It's an attempt to have a wave tank analogy. One of the things I've been struggling with is I've been talking about laminar flow and turbulent flow, but in fluids, when we talk about laminar flow and turbulent flow, strictly you need a 3D geometry in order to have full development of turbulence. And you get, you can get shocks if you're in 1D or 2D, but you don't get the full development of turbulence. So I was trying to think about a more constrained problem. So this one is, it's kind of a mix of 1D and 2D, but basically you've got bubble height as a function of the depth of the pool. And this is an actual wave tank where they've instrumented everything, so they can make measurements on the waves. So you're looking at the idea of Bitcoin bubble dynamics, how much power is in there. You're looking at wave energy concentration relative to a shallow basin or a deep basin. The difference would be as there's more and more market cap in Bitcoin, then your basin becomes deeper, right? So the wave energy concentration is relatively less. Okay, so early on, the waves are relatively large. With time, the system deepens as you have higher market cap. The same inflow of capital, even relatively, would produce smaller price waves because energy gets diluted down into the depth of the basin. It's not just on the surface. So I tried to actually fit a surface gravity wave model to the average bubble power. And I've shown before how the bubble power fits with 1 over time. But in this case, it's not time on the x-axis, it's market cap. So in surface gravity waves, the wave amplitude's largest near the surface, the energy decays exponentially with depth. And the deeper the basin, the more the energy will spread down into the depth of the basin. And you have this relationship where the height of the wave is an analogy with the power in the bubble, and that the analogy would say 1 over the square root of the market cap. And so the best fit had power, as I use percentages here in the bubbles, 300% divided by the square root of 1 plus a market cap term with some fitted constant. And that's the red dash line. And you can see it fits pretty well for the first 2, but it under predicts for the 3rd and 4th bubble. And R squared is okay. It's 0.8. So this is an attempt to try something. We do this in physics. We look for analogies. Sometimes they work, sometimes they don't. So we're showing something that doesn't work that well here. But then if we go straight to just fitting the bubble power versus a market cap using a power law, well, it fits extremely well. The R squared is over 0.99. In a way, not surprising. You've only got 4 data points. You can get high R squared with 4 data points, but not if you have the wrong model, right? Not if your model is imprecise. So the bubble power in percentage terms fit to the straight power law with a constant dividing by market cap raised to some power k. Fits extremely well. The k value is about 1 over 7. That is, bubble power goes as market cap to the minus 1/7, 0.143. It's almost exactly 1/7. Now you can see the projection here. I've got B marked. B is what we would hope for a bubble in 2025, that the market cap would increase to, say, 3 to 4, right? 3 to 4 trillion. And the B is located, if you look at these, dashed upward lines, the B is located between 3 and 4 trillion market cap. So that's a possibility for a next bubble, hitting there. And then one would expect that the power of such a bubble would be something like 70% on average. That's what the prediction would be if the bubble comes about. You can also project out to 2031 when you would expect, even post-bubble, 2031, you might expect a 10 trillion market cap, and then the bubble sizes would still be above 50 percentile at that time. Okay, this regression confirms the one we found before, which was when we did a power law, shown in this other smaller chart here. We found that it was t to the minus 0.83. That's the inverse of 6 divided by 7 power. And since the market cap basically grows as time to the 6 power, then these confirm each other. It's all consistent.
Very cool. It should be, right?
And that's it. It should be, and it is.
So 70% deviation, right? You say it gives us again something close to 200,000, right?
Mm-hmm. No, yeah, 200,000 would be a 4 trillion market cap, right?
Yeah.
Yeah.
Very cool.
So that B is sitting between 150,000 and 200,000 price points, roughly.
Very nice.
Yeah. So the takeaway is from this study is extremely good fit, even over 6 orders of magnitude of price, between the long-term liquidity index with a steepness like 10th to the 11th power for Bitcoin, responsiveness to that, which is really interesting. What that means is that liquidity wants to flow into Bitcoin. That's what it means, right? And then when bubbles happen, they happen because you have a prior bubble in liquidity, and it has to exceed 7%. And unlike the lead time between liquidity and Bitcoin in general, which is only about 1 quarter, that bubble proceeds by almost a full year. It's around 11 months on average. And that's where the strongest relationship is found. So it's a different way of looking at it than most people are talking about liquidity. It's got to reach that threshold. Right now, we're at about half that threshold. The latest liquidity growth for this index is something like 3.5%. So we need for that to double. And, Jay Powell's still sitting on his hands. We'll have to see what other central banks do. Certainly all of this turmoil is going to encourage, I think, some more liquidity in the system, because we're seeing the bond market breaking down. Seriously. Yeah. The bond market, in the JGBs, it moved 50 basis points in 2 days. The same thing roughly happened in the US for the long bond. And this is exactly why they pulled back on the tariffs for all the countries except for China. So those are the takeaways, and the bubble power, is a power law with market cap as well as with time. And
very nice.
Yeah, I'll finish there.
Okay. How is my voice? Can you still hear me?
Because
good. It's good.
It's good. Yeah.
Perfect. All right. So I did some theoretical work in the last week, but I was looking mostly at Bayesian way of describing the power law and what we can learn from that. But I did some progress, but I'm not ready to share the results yet. So maybe next week. But we can look a little bit at the market for a few minutes, and then we can see if there is any question, and maybe we end early this time. Yeah, so this is we discussed so many times about this idea that Bitcoin has two regimes, right? There is one regime where we are below it. So just to explain this graph, there are a few components to understand. The main one is the usual power law, right? There is always some, at some point, I think we need some kind of official terminology. So it's coherent, but usually when we do the fitting, right, we take all the data and the straight line in the log graph using all the available data. And this is what you get. You get the blue line. Now, what is the interpretation of that line? One possible interpretation is that it's not really the underlying power law. It's not really the fundamental mechanism. If I had to guess, and there is still some work needed to show that, I would say that the support is the support line that is about 60%, right? You can find it many different ways. You can use a quantile fitting and then basically eliminating outliers and doing that. And you can say, okay, anything that is between the lowest possible quantile, where I need at least a little percentage, maybe 0.5% of the data, all the way to maybe 45% quantile. It's very coherent power law behavior. We like the terminology that Stephen came out with, that he uses the word core power law. So I like a lot that. That is basically, this indicator is trying to show that visually. That is this green area, right? So the green area, until recently, we spent about 2 years in that region. And then there are these things called fake out. Again, I like very much this terminology that Stephen came up with. It are these regions where we leave this core behavior and we go above this blue line. Now, the blue line is not necessarily what you want to use to separate the different regimes. For example, both but in particular, Stephen has used Markov chains that are basically non-biased method that allows you to find different states and how you can go from one state to another. And he identified 3 states, right? There is the red region, there is a green region, and then there is a transition region. You can see how steep the transition region is when we go from one mode to the other one. And then we have this fake out, right? And usually these fake outs they don't last very long. Bitcoin doesn't like to stay there when it's not supposed to be there, and then it corrects and it goes back to the core when it's supposed to stay in the core. And usually that historically lasted 2 years, right? So for the first cycle, it stayed all the time there. This was almost like a textbook example. And then we transitioned, we went there. Now, we did have a small dip here, like a fake out in the other direction, but again, it lasted very quickly. It's one of these things that I think it almost confirms that once you go in one of these regimes, Bitcoin wants to stay in that regime. And we had a small fake out this cycle. It was the price started to be pushed up by these news about the ETFs, and so we reach the middle when we are supposed to be more close to this green area, and the price corrected. And then, as we were approaching the usual time when we go in the red area, we started to have again a bull run. But like we mentioned many times, I was worried because there was not, if you look at the global liquidity, the global liquidity was going down instead of going up. And so it was a little bit worrisome that we were not going to keep this momentum to continue to go to the 200,000 target. Now, assigned here two targets. One here, because there was some talk about maybe having an early top, when this appeared obvious that we were not going to do that after some time, but in the beginning of a bull run, that was maybe a possibility, like we had an early top here in the previous cycle. But usually the top, again, if everything repeats as before, and this is also something that I want to emphasize. I hear maybe from the people that don't spend a lot of time listening to all our videos, all the things that we say. One thing is telling the general behavior of Bitcoin that if anything, we are following the power law more than ever, because remember, the red area is when we leave a power law, when we actually go away from the power law behavior. Now, in general, these deviations are canceled out because we go up, right? We deviate and then we go back, almost like if the deviation didn't exist. So the overall trajectory is still the power law, even with this deviation, simply because they cancel each other. But now, if you have a situation where the deviation is not there, you're following the power law more than ever. And there are many different ways, maybe something that we can visit next time. You can calculate continuous R square, right? You can update R square and showing that actually R square is improving with time, it's not becoming worse. And this is exactly what is happening right now. And you can see even visually, right, that the blue line is going across. And in fact, you could have, 1 year ago, we were touching the power law, and you could have predicted what the price will have been 1 year later. And in fact, right now, that price is about 97, let's say $98,000. That is not far away from where we are, even after this great big correction that we saw because of the tariffs. Right? The tariffs created a lot of turbulence, a lot of uncertainty. And even if Bitcoin recover itself, it gets affected by these big event, right? These things that are unpredictable and unpredicted. Um, so we are still following the general power law. It's just that what is really different from all the other cycle is this extended period of time, this fake out, right? We did have long fake outs in the other direction, like this one. This one lasted a lot of time, but it was the other way around, where we were supposed to be in this green area and it went in the red area and stay there, but then corrected. But only it happens one time where we were in the red area and we corrected to go in the green area. Then we bounce very quickly up. We never had this, right? And of course, it doesn't have to be always the same pattern. It's something different, something that, this is what is useful when you compare, what happened in the past, because Bitcoin has all this regularity, and say, okay, this is similar, this is different, right? Now, many people are calling for the death of the cycles, that we don't have any more cycles, etc. I will say it's too early. We still have time to recover, right? In particular, if there is some liquidity injection that is going to happen, maybe because of this turmoil in the market, etc. So if there is liquidity coming in, it's not unthinkable that we go back and we still see a bull run, and maybe we even reach this target of 200K. I draw it here. Is where the target is, both in terms, it's like more a range, right? It's not particular, it's not like a dot. So this kind of red area. So that we do have time to go there. Now, one of the measures that I like to use to calculate, how likely it is or how possible it is for us to reach that value is thinking that we go up like an average, right? Or at least in equivalent fashion to an exponential. So exponential means constant compounded gains every day, so returns. So that will be the equivalent of having an exponential that grows 0.39% every day. We need to do that for about 8 months to reach 200K. It is quite a bit to ask, right? In particular, as Stephen showed, the volatility is going down with time. This is something that Bitcoin will have done pretty easily a few years ago, but it's becoming more and more difficult to do. As a comparison, if you take, if you go from when we cross the blue line, not this first peak, but actually the second peak, if you connect the two, right, in a log linear chart, if you had one single line that connects these 2 points, it will be an exponential, and that exponential grew at about 0.44% a day. So Bitcoin can do it, or it has done it in the past, at least with the last cycle. So it's a little bit less than what it did last cycle. So it's still doable. Now, of course, if we spend more and more time moving sideways instead of going up, then this number becomes bigger and bigger, and it becomes less and less likely. The question is, do we have a bull run at all? Where we actually go above a power law and we stay there and then we correct, or we continue to move sideways. These are things that are very difficult to tell. There is this big talk, and it's kind of interesting because we should kind of revisit that on the light of what Stephen discovered. That he says, if we take face value is Granger causality studies, that really there is not a lag that works well, at least, right? That gives us at least statistical significance for what concerns the bubbles, right? You look at the core. So yes, there is a general power law relationship, is very clear and very strong. But if you start to look at a particular lag that will say one quantity leads the other, that is what the Granger causality test shows, nothing really works very well besides the transitions, when we go from the core to the bubble. So, for example, this idea that there is this lag of 70 days that kind of matches some of the features. And in fact, I want to know what you think at the light of what you were telling us, right? So, for example, there is this. You find many posts online that says, "Oh, look, this component here, this component here, this component here." Basically, since last year, February last year, in fact, even early January of last year, of 24, it seems that we see a very nice match. And if this match is real, then, and we follow, then we should go up, right? We are supposed to go up very soon because the
Right.
liquidity went up. So what do you think about this?
Well, yeah, I think that's generally right. I mean, liquidity is a driver long term. We know that. We see that. He gets a high R squared. I get a high R squared. Um, the lag, there's a little more flexibility interpretation, but most people are saying for the base liquidity index, and people use different ones, that's about
Right.
a 11 to 13 week lag. So we had
Yeah.
a downturn in liquidity in Q4 that affected our prices in Q1. We've had an upturn in liquidity last quarter that should be kicking in. But to get a real bubble, it's going to need to be substantial. I'm saying
Yeah.
it's going to need to hit that sort of 7% or higher year-over-year growth rate
Hmm.
to
I see
power,
what you're saying.
to
So yeah.
power through the transition zone. Because now what we
Yes.
saw is a rise and a fall and a rise and a fall into the transition zone. We entered a little bit last in Q4. We entered just a little bit into the bubble zone, but that was a fake out. and it was never confirmed by gold. We only saw it in fiat. We never entered the bubble zone in
Right.
gold terms.
Yeah, because even if you compare, for example, the last bubble, right? Look at this, right? Look how consistently up the liquidity went, right? And even if the correlation is not 1-to-1, it was a consistent growth of liquidity, right? But if not necessarily a driver, because maybe like you say, kicks in, right? I think it's almost like I called it in the past a necessary but not sufficient condition, right? It needs to be there, the liquidity needs to be there, but you also need other factors for the bubble to happen,
I'm
right? Like
calling
in
it a
particular,
trigger.
FOMO. And so
I'm saying
a trigger. Okay.
I'm being a
Yeah.
little stronger and saying it's a trigger, but if you trigger it and then you could get a fake out bubble, right? Because
Mm-hmm.
the rest of the momentum trade doesn't happen, the FOMO doesn't happen, the
Right.
hedge funds or institutional capital don't move in large degree sufficiently to sustain
Yes.
that. So the trigger is an
Yep.
opportunity, but it's not the follow through. And it's
True.
not really. Yeah, of course, the liquidity index over long terms is rather smooth, right? With the exception of post-COVID, it's kind of 7%, similar to the M2 money supply growth for the US, which also had that weird behavior post-COVID. So you
Yep.
wouldn't expect something that's kind of growing exponentially as a 7% on average to do anything as a driver. It's the changes that matter. It's the residuals that matter in order to drive the Bitcoin residuals, which is what we need for a bubble. And I
Yep.
think what we saw is they had that, they went overboard, right? Because there was a lot of fear with this supply chain disruption, and they went up to 20%. And then all the central banks withdrew it. And so liquidity crashed and went negative for the first time ever. Right? And
Yep.
that's why we had such a down market in 2022. Then we recovered 23, 24 as that liquidity has slowly come around. It's actually still below 7%. It's still below the long-term historical, right?
Mm-hmm.
So it's still trying to catch up to its own long-term trend. We've been suffering.
Yeah.
And this is actually a real testament to Bitcoin's strength, to its anti-fragility, that from December 2022 to now, it's increased by over a factor of 5, even though liquidity in general has been very low growth throughout that
Yeah.
time.
Absolutely.
I mean, it's collapsed and then it's been low, hardly recovering.
Yeah. Yeah. So maybe we have like a mini rally or something. It's not anything that looks yet like a sign of a strong bull run, but we take anything at this
Well,
point.
I think we'll probably get it because there's a lot of turmoil in the markets now, and what's happening in the bond
Yeah.
market and so forth. I think we will get it. It may be delayed.
Yeah. All right. Let's see if we can take some questions. And so we have this one, for example, that talks about energy. I'm not sure which energy are you meaning. Do you mean the energy from the hash rate? Because we have already pointed out many times, right? There is a relationship between hash rate. Sure, that is something that could be explored more. And I think Stephen has done a lot of work on that too. Do you want to
Yes,
say
I do.
anything
I mean,
about
I've
this?
thought about it a lot. The problem is getting good data series for the input. We don't really have good data series for the electrical energy consumption. You had the Cambridge Center was tracking for a while, but their numbers were all over the place. They had a dynamic range of more than a factor of 2, so highly uncertain. And people were even questioning their numbers to some degree. And it's just a very uncertain kind of input. that we have. So if somebody can point us to good input statistics for the electrical energy, and then we have to fold that in with the change in performance of the underlying machines and the number of machines.
Yeah.
So we've got the 3 series that we need to know. We need to know the electrical input. Electrical power input is a function of time. Right now, it seems to be about 19 gigawatts or 20 gigawatts. We need to know the average hash rate per machine, which we can get a range for by looking at, machines that come out in the last year or two. And I produce reports twice a year that go into that a little bit. And then we need to know how many machines. And we don't know how many machines. We actually back out estimates as to how many machines by looking at the overall hash rate and estimating some kind of average machine hash rate, or looking at the overall electricity and then estimating, the average kilowatt consumption, which has been 3 and is now heading rapidly up to about twice that. So it's very imprecise data that we have. That's the problem.
Yeah, what is interesting, the closest thing to this is actually this graph. So what we do here, I take just hash rate. Like as Stephen explained, it's not the ultimate, because even hash rate, it's kind of a derived measure, right? What we know is really difficulty, and then people go from difficulty to hash rate, right? But to do that kind of calculation, you will need to have more information about the energy consumption of a machine and so on. But even if you take this rough measure, right, of hash rate, I converted this quantity into a price because you can fit a power law. It's a power law that goes price proportional roughly to the square of hash rate. And we discussed this before. So even if you take this, what is really cool, and I want to understand this better, there was, for historically, we were always above. So in theory, you should be able to reconstruct this red line from hash rate, right? And you do if you make a model, a time model. So how do you get this red line from hash rate? If you make a time model of hash rate, so basically our hash rate changes in time, and then you relate that to price, you get back the red line. But if you use directly hash rate and its relationship with price, you get the yellow line. And you can see roughly, right, they all follow basically the same pattern. And this pattern was more precise in the past. But now, what you see that there is a convergence of this yellow line, in fact, even the purple, that is addresses, towards the support. And it's kind of interesting. I don't know, I don't think it's a coincidence that since this is since June actually, of 24, we have followed very closely. So basically, it's almost like it looks like it spikes and then it goes down and touches that support line and it's moving along that support line. That it's really interesting. What do you think about that, Stephen? Do you think it's just a coincidence or there is something else there?
I don't know. Hard to say. We know difficulty precisely. So difficulty just being a fortnightly average of hash rate. So difficulty gives
Right.
us a precise input for the longer term.
Yes.
However, it is spaced as a function of the number of blocks, so it moves around a little bit in duration. That makes it a bit messy. But I think the hash rate has been flattening, but we don't know for sure.
Yeah.
And I think it was easy for it to track the 11th power of time early on because you were shifting from CPUs to GPUs to ASICs and kind of lower end, not really highly designed yet ASICs to very highly customized ASICs at the front end of the technology curve these days. So you were getting extra boosts from several levels of quantum technology jump, if you will. And so in a sense, you're better off just doing the regression from the time the ASICs were adopted around 2013 or so. And then it's it's somewhat flatter. It's more like the 8th or 9th power.
I see. It's something that we could check. Yeah. But I found it curious that he's following that support line and has been doing this for quite a lot, some time. And I want to understand it better. It's possible that it finds it kind of his own, that relationship is the relationship between hash rate and price, and is settling on this, maybe because it has reached some kind of equilibrium in terms of efficiency, right?
We should look at the
related to that.
Have you looked at the Granger? Price normally drives hash rate. Have you looked at the Granger?
Yeah, I did. And the result was that price drives hash rate beside the bottoms. At the bottoms is the other way around. I can show you the
What
graph.
was the lag? What was the time lag?
I don't remember exactly, but let me actually revisit, because it's time to revisit that study, and maybe this is what we can discuss next time. Maybe you can try to reproduce it too, because it will be nice to compare notes. But so it's actually interesting to do it both with addresses and hash rate, and the result was, in general, price. Like, many people think that like Kaiser, right? For example, Max Kaiser, he thinks that hash rate is the ultimate leading indicator. It's not true. Price leads hash rate almost all the time, besides the bottoms. They kind of make sense, because I think what happens at the bottom, basically miners give up and they are in control of the situation. Basically, the sellers are exhausted, and then also the miners starts to not to sell the bitcoins, and then when they actually push the hash rate to produce coins, to whatever mechanism is going on, we will actually have to think a little bit more about the interpretation.
In general terms, when you get crashes, the weaker players in the mining industry suffer, and they have to sell off some of their machines, or they have to redirect their business plans, or they get bought out by other players. And so what happens is that the hash rate moves from weaker hands to stronger hands. You get some consolidation, and those stronger hands also are more efficient. They have the lowest cost power. They also have deeper pockets, so they're able to look forward in time more, and then they're willing to take the risk and invest towards the bottom. And so they hold their coins back, and they invest in next generation equipment. Hash rate starts going up. So I think in that sense, Kaiser is right at the bottoms, is that you get this ultimate support from the stronger players, the stronger miners. Now, the miners are also diversifying. Most of them are now going into the HPC AI business as well. And so they're doing hosting, in their data centers for AI workloads. And that's going to make them a little more resilient to the bubbles and crashes.
So usually goes like this, right? Roughly. So we see. Oh yeah, you're right. Square root. Let me hide. Let me redo it. Price or hash rate equal or proportional to price square. Yeah, this is how it goes. And then you have addresses, or actually price. It's proportional to addresses square. This is the Metcalfe law. It's not exactly square, but close to it. And then you have the addresses grow with the time cube. And this is how you get that price is proportional to time to the 6. Yeah. But yeah, it's very interesting. There are all these relationships. But yeah, we should revisit the Granger for both addresses and hash rate. But it's interesting. We could also try to do it according to the different technology, like suggested, right? Try to do it. How does it look after 2013? Because the technology was different. Yeah, that is something that we should look at. All right. I don't know. There is these other questions. We can maybe try to find power laws around the energy and tie to Bitcoin. Yeah, we try, right? And hash rate is the closest thing that we have. But yeah, to transform it into real energy, like watts, for example, or power, it's a little bit more complicated because there are people use energy in different ways. Some use solar, some use gas, or other renewable sources. So it's difficult to go from one to the other. One could maybe work it around. I don't know. It's something interesting to explore for sure. Yeah.
The
We are
energy
missing a
use is
component.
flattened out considerably. I mean, it was growing very steeply, but in the last couple of years, they've gotten very efficient. The efficiency of the machines keeps going up. I think the number of machines is not climbing as rapidly as it was earlier on. And so the total energy, I remember in 2017, there was a guy who was a computer scientist at Lawrence Berkeley Labs. He published a paper in the IEEE journal, and he made it sound like Bitcoin was going to consume all energy within a few years. And I wrote a rebuttal on Medium. That was in 2017. I said, this guy's ignored the capital costs. He's ignored the efficiencies. He's ignored the economics, et cetera. And they just keep getting more and more efficient economically. That basically you need to be below 5 cents a kilowatt hour. The most efficient are down around 2 or 3 cents. And, if they're sitting in West Texas, they write contracts with the Texas EPCOT Energy Authority that relate to the peak load so that they cut back, when the demand for air conditioning is high. And that gives them some favorable pricing. So it's very complex, even the translation between energy input and the hash rate that comes out.
Correct. Okay, guys. I think we cover a lot of interesting topics. We will see you again next week.
Yeah, I'll be away next week on holiday.
Okay.
So I'll see everybody in 2 weeks. Thank you for listening today.
Yeah, maybe we could take a break for 1 week because it's I need to have my co-host. I cannot do it by myself.
Your choice.
Thank you so much. All right, guys. So thank you so much. See you in 2 weeks, man.